Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened
Yeah, I lost the internet, folks. Sorry about that. It just completely went down in here.
Our policy rate well into restrictive territory, and we've been seeing the effects
Well, listen to Paul here.
of economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago.
Echo will go away now.
The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
Yeah, of course that happened. Of course you can't hear me. So maybe that was good. Yeah, very frustrating when things get too disrupted like that. I apologize. It was not my doing. Anyway, yeah, so you all missed a great, really good rant. I was in flow when the internet went down, so that's pretty classic. Yeah, that was me. So let's try to get back into flow. The Fed is obviously still kind of going, we're not going to lower rates. That's been the dialogue. I went through, I'm not even sure how much you folks were able to hear of what I said earlier before the internet went down. But my whole premise is this QT, and Paul just mentioned the QT, that they've got it down by maybe $1.5 trillion in the better part of 2 years, year and a half plus. And that's an issue because to get it down to the numbers I was talking about when I started the previous broadcast was that we need to get back to $6.5 trillion is my estimate, where we need to get it. The pace that they've been going, that's going to take another year and a half. And that would be really bad. I think what probably happens, the Fed still got their tail between their legs as far as the whole inflation thing goes. They got caught with it was transitory, and we know all the story. It went from transitory, but no, it's not. Now it's sticky, and now there's you hear in the background talk here when he's talking, is he's saying that, hey, this stuff is the longer term expectations and market expectations and inflation are higher than what they would like them to be. So they're going to keep things higher for a while. And I've been talking about maybe it's appropriate just from that dialogue to talk a little bit about some of the things that are likely to happen as far as the yield curve goes. I've been talking about that for a while. I might be able to put you folks up on a screen for a few minutes, and maybe we can draw on a drawing board and talk about it. But I think all we really need to understand on the interest rate scene is that we're locked in around this 4% level on the back end of the curve, starting at, I would say, 5, 10s, 30, and that back end. On the front end of the curve, we're a little elevated in the 450 plus range, and then of course in the very front end, since the Fed's maintaining their current Fed funds rate, the effective rate is roughly 533 every day. I think that was the number this morning. So we're looking at really 530s. We come into the 13-week, get to a 1-year T-bill. They're going to stay above that 5% range, probably 5.15, 5.25. And then as we get into, we start, the threes are not really well watched, but the 5s, 10s, and 30s will start to just stay stable here. And I think those are the numbers that are important. Folks have been focused in on the inverted yield curve for a year and a half and sticking with their guns that there's going to be a recession because of those numbers. And I told you, not going to be a recession. I still don't see a recession. In fact, the scenario that I was talking about a bit ago is really productivity increasing, and that over the next 3 to 5 years, we actually grow our way out of this debt. I know that sounds, like I said, I don't know where the internet got cut off on the previous live cast that I was doing, but the bottom line is that productivity goes to where I think it's going to go, GDP is going to grow, and therefore everything's going to get much, much bigger from the standpoint of the overall base of the economy and what the Feds and the Treasury and everybody's going to have at their basic usage, including tax base, everything. So without breaking and getting down into the weeds on that stuff, we're really looking at the potential to grow out of this debt, and all of a sudden you're back at 40 or 60% of the GDP ratio to total debt. And I kind of laugh to myself. There's some guy that I follow on Twitter just because he does these rants, and I want to hate him, but I can't. And I'm trying to bring up my Twitter account so maybe I can see him. He's a conservative guy, but he's got kind of a voice, and he hem-haws and whines about all the debt and how it's almost like an extension of zero hedge. And I've been telling you, if you want to know what's not going to happen, go to zero hedge. Not that everything that they've had in there are bad, but for most part, all the doomsday stuff that is being projected is not, it's not going to happen. And that's what I've been telling you. I'm very, very optimistic going forward in our economy and what's likely to happen from productivity and GDP range. So I just don't see it. I think we're sitting here, folks, in the, we'll call it the Henry Ford moment. We're going back to the second industrial revolution, where automobiles and automation of a lot of things, manufacturing, those things changed a lot of how the economy operated. And we've watched this, and this is one of my arguments when you're looking at the U.S. economy, looking at the world economy, and people are always trying to look in the rearview mirror. Well, back in 1930, well, it's not 1930, it's 2024, and the metrics are different. The banking system operates different. We can move money in nanoseconds now, where it used to take 2 to 3 days to settle any kind of transfer. There was a time where the banks could settle, I think, in 2 or 3, but they were making all of us, if we were transferring money, it was a 7-day settlement. So they would literally be making money off of that float. There's still a float, but that float has went away substantially. But what it does, it makes everything much more efficient. As markets get more efficient, as we get digitized, especially like going back to decimalization back in the markets back in the 90s when that happened. I used to be a floor trader, and one of the guys that ran the hedge fund that I worked for said to me, I went and visited him. I hadn't been on the floor for about 4 or 5 years. I was in San Francisco, and I went up to see some of my old friends, and the guy that ran this hedge fund, he goes, it's not like it was the old days. There's no juice left in the market. So every time we've seen these transitions from decimalization and then the settlement time getting shorter and shorter, ultimately should be same-day settlement. There's no reason why it's not now. So the brokerage firms and all the clearinghouses are still playing a little bit of the float game, and they're still making tons of money on that because the money is so big relative to what it used to be. So there's still plenty of money. The efficiency is there, but the money is also still there, and that's what's driving all of this. So we have a lot of liquidity in the system here. Let me get Jay Powell out of the background here. So we have just a lot of liquidity in the system, and that has been the one thing that saved us from the, I'm going to do air quotes, the banking crisis last year that never happened. I see that I think KRE is getting hammered today for 3%. So there's a New York bank with some issues. So markets are quick to respond. It's probably not a systemic issue. I haven't had a chance to look at it. But my point of all this is you're going to have, banks are in the risk business to a large degree, especially the commercial banks. Those folks, there's always going to keep this story about CRE, commercial real estate, and all of those things continue, and they'll be ongoing. But in the end, they'll all be handled, and there's plenty of money around to actually handle these situations. Let me get rid of this little dinging noise here. Okay, so yeah, it's an interesting world we live in. So I wish you folks could have heard that rant that I was on when the internet was down. I didn't realize it was down. But anyway, we've got about half of the viewers back. Man, that's disappointing. See what you folks are talking about. Yeah, the great, even someone says if the debt doesn't grow at the same rate, it won't, by the way, not if you get to these productivity numbers. I have some numbers. I did some research on this, on the, and even if debt were to grow at 10%, see, once you get the cash flow to a certain level, you don't need the debt anymore. And that hasn't happened. They're still spending money like drunken sailors. We know that. We're talking about 2025, 26. There's going to be a new administration around. Who knows who'll be running what as we come into these latter years. But I think it's, I've referred to the some of these things that are out there right now. What's going on right now is kind of the roaring 20s. If you look at the reset that happened after we saw, after the pandemic, I mean, that the market got creamed. It has been straight up ever since 2020 for the most part. We had a down year in 22, but for the most part, it was down. So let's see here. I'm kind of getting an urge to kind of go into something, and I'll come back to it. I'm just looking at what time we got. Let me go to another screen here. let me come over here. Good. Now, I'm telling you, this old machine is not running like it used to. Yeah, that's why I'm trying to get to another screen, and my little screens are not changing. Usually I push a button, and let's see what this one is. Yeah, here. Yeah, so there's the roller coaster somebody was just talking about. I'll put it up here and just take a look at what's going on. We're back to 10.49.10. We printed up to 29, and then back to 10 here. I'm not sure we're going to be able to get out of the way here from the standpoint of what's going on. Yeah, folks, listen. I'm just looking at a couple of things here, and I see somebody brought up, World War III, and listen, that's a game changer. That's more or less, maybe it's a black swan type thing, but in real world, if you can see it, that everything that's going on, is it really going to be a black swan if something happens? Maybe if there was some attack. Only thing I would see is if there was an attack on mainland U.S., that would be pretty big. Every war we've been in, we've been isolated here in the U.S. from any of those things actually occurring, meaning that we've not had to fight a war, have to go back, way back into the 1800s to get into that stuff, and not civil wars. But I think that's probably more of a threat than World War III, to be honest with you. I live in Arizona here, and also have interest in state of Texas, and I can tell you, folks are pretty much fed up in both Texas and Arizona from the standpoint of what's going on. So I would worry more about that. Yeah, and I see somebody mention we're not watching Paul, but yeah, they're not going to lower rates. Like I said, only thing that matters is when they say we're not going to sell any securities anymore. That will matter, and when that happens, I'll break it down. I've talked a bit about that today. So the standpoint of what the impacts of that will be, I think, will be major. They're not going to lower rates. There's no reason to lower rates. I mean, why would you lower rates? Look at the JOLTS numbers came in stronger again. Employment numbers, everything, the employment situation is strong. There's nothing they can do to knock this down. And I think it's interesting that folks are still kind of hanging on. I mentioned this earlier, to the inverted yield curve, and that whole scenario. There's going to be a recession because of the inverted yield curve, and I've argued for a long time, no, there's not. And now we're in the range where something should start, if that scenario were to play out, that the inverted yield curve would happen. I saw a really interesting thing. I think it was posted on Twitter, and it was I think the economist from SoFi. You want to talk about a good fade. They're talking about 5% unemployment, treasuries going up, and that's their scenario they're playing. So you can fade that trade pretty good. Like I said, 4.25 is about the top end that I see that we could get to. Yeah, just looking. This is a 1-minute graph that I've got that you folks are looking over my shoulder here, and we're Yeah, it looks like, matter of fact, if we look at the algos, right now the algos are suggesting a possible little turn if we can hold above this 200 moving average here. Maybe we can get a little bit of a rally up, but it won't be much. It's going to be locked in a range probably right now of 49.10 to about maybe 15.16 at the moment. And so we'll continue to watch that. I'll just kind of interact with you. I'm just looking at some comments here. Yeah, Greg, I'd love to talk a little bit more about the military age folks that are pouring through the southern border. That's kind of scary. We could do a whole broadcast, but this is financial, so we're going to stick to that. I do have plenty I'd love to talk about, but we're not going to. But here's the thing: those folks that are coming across are, I guess arguably also are working folks. If there's so-called infrastructure jobs and things of that sort, they can be trained. If you recall, going back to 2006 through to maybe up to the housing crisis, if I'm in Phoenix, Arizona area, I now live up in the mountains, but at that time I was down in the valley, and what was happening then was a lot of Hispanics, Hondurans, all kinds of people, South Americans were working on these crews, framers, all that. When the markets collapsed, when the real estate markets collapsed, and all that building went away, then that workforce got distributed out, and now there's still a lot of building to go on. And I guess I was flashing back to this, and you folks have known me for a few years, but I was flashing back to some previous times and in life. I put some stuff out on Twitter, pictures of my newsletters. My very first newsletter I wrote was on August 26th of 1986. That was the first time I wrote a newsletter for what I had a company, my own broker-dealer called Kendall Financial Group. And it was a broker-dealer. It was also introducing broker. I had been one of the top producers at Prudential and started my own company. I get tired of people didn't understand what I did, telling me what to do. And that kind of started me into more of a research role, more of an analyst, and those type of things. I kind of became my own everything. And I've been a multitasker. I had a computer on my desk since 1980. And so for 40 years, I had an Apple II with VisiCalc. So I've been really into the technology. But as we look at where we are today and everything, you can talk about black swans. I've tended to be, for the most part, actually called the crash in '87 really, really well. Had the proof of it. Had a nice black turbo Porsche I bought right after the crash. That was one of my rewards for being right. But everything always has been painted out that when I look forward, America was still there. The world was still there. People still wanted to work. People desire, all of us that are on this stream right now are wanting to move on with our life. We have goals, we have families, we have other things that we want to do. And, I'm at the far end of the spectrum now. I'll be 72 this year, so I've already been through all of those phases of life that a lot of you are in the middle of or coming into. And that is so motivational from that standpoint. And as messed up as society is today, those desires are still prominent, I believe, with most people out there from the standpoint of wanting to do that. So that's why I've always been an optimist to a large degree. I'm a short-term pessimist and a long-term optimist, and it's always been that way for me. When I look out in the future, I'm going to do, like I said, make sure you get signed up for the Substack, Kendall Report.
Substack.com, $8 a month. On Sunday for Monday, I'm going to write up the longer-term viewpoints of what I see happening in the market. I'll probably have at least one, maybe two YouTube videos that will come out next week to kind of back up some of this stuff. But the realities are is when you look out, it's still optimistic. And and the World War III's, and all of that, they could happen. It's one of the things you learn after when you get old is you just deal with life as it comes at you. And sometimes it's good, sometimes it's bad. As I've said before, I've been lucky enough to have more good than bad, but certainly I've had all of the above. You don't go through life, none of us unscathed, as they say. So whether it's divorces, losses in family, all that stuff, it's life and human life. So, but I think that what I always see is I'm optimistic for humans. Okay, I wish I'm with Elon Musk. We need to make more of them, and we need to get a lot of things under control that seem to be out of control at the moment. But the forward-looking aspects of the potential for, and I think it goes beyond potential, folks, on AI. I'd said the other day, and this is something else I'm going to work on. I'm writing right now. I'm writing a letter on ETF hacking. It's going to be a multi-part document that I'm putting out that's going to go step by step how you can do it. We're going to put out a special on making sure that we get people that get committed to doing this, the folks that have 401ks and that. We're going to make it really easy for you to commit, at least to make a serious effort on doing these things with technology that I built. And then, what I'm trying to do with all of this, what I'm trying to do with all of the efforts I'm doing is trying to move us all forward in a good, solid way. So optimistic, I'll stay. I think GDP goes through the roof. I think debt becomes a non-issue 3 years, 5 years from now. And think about it. It's like if you watch the news, I keep telling you folks, you want to be good at the markets, just be a contrarian to a large degree. Everybody is telling you about the debt. Therefore, it can't be the problem. There's something else that out there. It's like, do they not want you to participate in the boom? So here's where I was going to go. I'll go down this trail a little bit. Is that I think that the opportunities in AI are not just with NVIDIA and the obvious Microsoft, all those folks. I strongly believe that mid-cap and some of the small-cap companies are a nightmare, zombies walking around. It's literally, a zombie world in the small-cap world. But as you get into mid-cap and lower capitalization, large caps, whatever, that's even hard to define anymore. We got two companies over $3 trillion in valuation now. But when you get into those are going to be the companies, those will be the companies that you're going to be able to benefit the most from, that they are going to figure out how to take AI into their businesses and get productivity to grow. And, so I always say you want to find the mid cap that can turn into the large cap, and better yet, a small cap that turns into a large cap. And you want the basically the capitalization of that company to double and triple. That's where the money's going to be made, not in the companies where you're going to make 15%, 20%. You should be able to get, three baggers, maybe more, out of some of these companies that are out there, because they are going to be the ones to benefit. That's where I'm talking about. So the reason why I'm kind of forcing myself with this ETF series that I'm writing on Substack that I'm getting. I finished most of part one. I just need about 2 more hours. I'm going to get that out the door. And also I'm working on basically a pretty in-depth book on PPMs and some of the other stuff on our indicators. We're going to get all this stuff out. Like I said, I'm having fun writing again, spending my time doing that stuff than what I've been doing with it in the last couple years. I'm just kind of coming into a new phase, if you will. But the bottom line is these companies, these mid-cap, these small-cap, those are the companies where you make the money from AI. Not that there's not money in the folks that act and look like NVIDIA. I was down in Phoenix yesterday, and I can tell you I drove by the new TSM plant, that Taiwan Silicon new factory. It's going to take them multiple years, and I laughed. I said to my wife, I said, it's amazing what people will do to get a computer chip, to get silicone. It's amazing what, they're building this massive thing. Doesn't matter where you're from, Taiwan. I mean, we've got great companies here, Intels and AMDs and folks, but, it's just like the reason why that's happening is because of the need that's going to be to fulfill that silicon chip it's going to take to drive this thing I'm talking about. And if all you have to do is look around and see where the real productivity, where the focus is. Okay, so a little bit of a ramp. Harry's talking about, what do you think about quantum computing? All of this stuff, folks. This is where we're going. This is the fourth industrial revolution, and this one will. I put in my annual report. I went through, and the best I could find, and go all the way through the previous 3 industrial revolutions and tried to see what the effects on GDP was, at least from a historic standpoint. And I think I did some pretty good investigation there, and none of those previous periods had growth periods, I think, close to 3% when in the 60s, and when we started to come into basically the world we're in right now from the standpoint of the computers and the computing, and now we're going into a new phase, not only quantum computing, but the encryption and all of this stuff is just going through the roof right now. And I think that this is what I'm talking about. I'm not an expert on this stuff. I'm just a guy looking to invest and try to figure out how to benefit from it, and from what I've been doing for 40 years. And it appears fairly obvious to me that these things that I'm talking about. So I keep going in a loop here. Let me go back one second here. Is what I'm really talking about. Like when I'm writing this letter on ETF hacking, I want you folks to be able to read this thing. Even if you don't use it's going to be a lot easier to use it with our technology, because we can monitor a lot of assets simultaneously, mix them into a portfolio. We built a virtual portfolio manager. That's WaveTech is VPM, which is a virtual portfolio manager. So you can handle a lot of assets and mix them and all that. We're working on automating the entire process, so it'll just go right to your broker dealer. But the point of that is I want this document to at least give you folks the ability, when you go into ETF hacking, for years, folks, we did the same thing with mutual funds, and I'm not talking about hacking indexes. Who cares about indexes? The managed ones. I mean, you got to find something a little better than ARC, even though it's bounced a little bit. There's some really good thematic views of the world that you can go in and chop it out. Last year, a year ago, right now, I was telling you folks about the home builders. You would have followed that, went in and there were 21 stocks that I chose out of there, and that got you 75% return last year on 21 stocks, just following the bouncing ball. And it's like, I always joke that Wave Tech is like karaoke for the markets and with auto tune. And it tells you what the next word is and how much to buy and all that. If you just did that, it was a 70, I believe, just that 76% return in a market, in a sector, in an industry group that was supposedly going to collapse. And this goes to my contrary thoughts on how to do the markets. I just look at things a lot differently, and I listen. I don't have it on right now, but I have a TV over here. Usually I have Bloomberg on, and it is absolutely a gold mine for contrary opinions. And especially when they have the Bloomberg analysts on, these people are good, okay? They got it mostly all wrong, and they're giving you all the right things to do or the absolute places to stay away. Most of these people on all of these networks, they're buffoons to a large degree, and it's unfortunate because the channels like CNBC and Bloomberg, they don't allow these people to trade. And I'm going to go down this trail. I've got somewhere else I'm going to go right after this. But I was asked to be head financial analyst for a firm. We had about 5,000 reps, and I told the COO, who was a good friend of mine. I ran a large division at the time for the firm, and I told him how I wanted to be compensated for giving advice out to the firm. We used to have this little squawk box, have a little microphone, and you would talk into the squawk box. You could talk to everybody that had it on their desk, and I was on every morning. So I said, here's how I want to get paid, and there's a point to this. As I want to be paid, I want you folks to give me a house trading account, that every trade that I tell our people, our brokers to do, that I have to put that trade on in that account. And I get compensated for how well that account does. I get 50% of all the profits from that account, and you guys take the risk, but the risk goes to whatever you would pay me to do that job for a year. So I said, don't pay, and then this way you have no W-2s to put out. You cut me off. I'll still do the analysis if you want me to, but that's how I get paid. And I had a crazy year, and unfortunately the firm blew up, and we won't go through the whole story. I should probably do a video on that. I could bring on some people that were associated with that, good friends that for a long time. That was 1990 actually. And but the point of this is there was skin in the game when I had an idea, and this is why I try to get people to make sure it's easy to talk about things, but these people on Bloomberg, CNBC, all these stations, if they had skin in the game and they had to put skin in the game, they would say a lot different things. That's my point. There's accountability in what you say. And so when you and I, individuals, I know some of you are investment advisors that watch me, we have to make decisions that even affect ourselves or other people. And those are big decisions to make. And unfortunately, a lot of folks don't take very good responsibility, and you get punished for being wrong in the markets. And if you're an individual, you get punished by losing your money. And if you're
an advisor, you get punished by losing somebody else's money and then getting fired, and that's how it should be. But they're big decisions, and when you take on the accountability that's necessary is when you do the best for yourself and others. That's just the way it always is, right? So investing is no different. Sorry to get, there's a little rant for you, but my point is I'm an optimist. I want to give back to you guys. This article series of articles I'm writing is actually going to be, I just finished the philosophy, the concepts behind it. There's a couple things the first doc is going to have. The next doc is going to be talking about starting to shred these ETFs, because think about it, these ETFs, even though Kathy Wood hasn't done very well and she had too many meme stocks and she's a keep buying more and buying more until you run out of money kind of person. These folks spend a lot of money researching, especially the ones that are doing managed strategies or specific style box strategies, and those are the ones you want to go to. You don't want to you can ETF hack at SPY, but it's why. What you want to do is you want to end up just like with the XBH that I hacked last January. Is I think there was 80 some stocks in there. I came up with 21 stocks through the methodology of honing them down, and that made there might have been some that I missed, but the returns on that was very good. So I'm going to pass. That's one of the things I want to pass on, and like I said, that's going to be on the Substack as well. Yeah, you know what, Good Life, I don't know who you are, but send me an email, info@Kendall Report. Maybe we can talk. Interesting. So we said it, right? So I still have the chart up here. So we went down. So it looks like JR42, Fed to focus on balance sheet going forward. Who is SS Warrior? Watch them, Smurfs. Hey, $100. Abbey Road, man. Nice to see you. I wish you'd spend that money on our products. I would rather have more than just words to give back to you. But thank you so much. And just look at some comments. Yeah, just there's just a lot of things that I think I've had a lot of time to reflect. You know, one of the issues with doing the daily reports that I do is when I was doing daily live, it just took so much time I'm still spending that same time, but the nice thing is I'm doing it later at night. I'm a bit of a night owl, and I like to stay up, and it's a time where there's nothing around bothering me and I can think clearly. And that's when I always like to write, and but it was very distracting doing the dailies, and it was really affecting a lot of different things here from that standpoint, and yeah. So I'm just looking at some more comments. Yeah, Brad, what cash markets? What I'm trying to do, and questions about the Substack here. This was last night's report. Market turbulence ahead, and we're definitely getting it. Just hit. There was some things that are starting to show up here on some of the indicators. The algos were right at, it was funny because if you go back several weeks ago, nice thing is you can go back to the reports and see some of the different aspects of of what I was saying and all that. So yeah, I'm just looking here. Let me do a couple questions here real quick since we're hanging out, and we'll go back to markets here in a little bit. Excuse me. Yeah, so as far Brad, as far as the S&P, NASDAQ, cash, I guess I could do that. There are some slightly different contexts there. Because the cash sometimes won't fulfill some of the elements that the futures do, because futures are trading virtually 24 hours, not quite, but for the most part, 22 hours, 21 hours minimum. So you do get some different price movements there. I'll take a look at it, see what it would take. How about this? I'm talking to Brad here. How about if I just added the charts and let me take a look, and maybe I can put a brief comment to update what to look for in a cash market. I'll take a look at that. Yeah, so let's go back to markets here real quick. Yeah, 4902 is big number. We're printing what, 48.91 last trade. Let me see what the low for the day was. Low for the day, 75. It's interesting because I'm just bringing up. This is something we'll want to watch for here, folks. Right at the close, the PPM1 is going to turn up here on, let me go full screen. Yeah, we're looking at an hourly graph here. It looks like the PPMs are going to try to make somewhat of a turnaround here on the final hour. So as we come in overnight, we'll probably come back into these moving averages. I may start to include one of the, I think, more powerful things that I used to do on my daily live streams is talking about the hourly movements and forecasting different ranges. So maybe I'll bring that in. Yeah, just going back to Brad real quick. Yeah, so I think this weekend is going to be very helpful to you because I'm going to go through quarterly, monthly charts, and I usually focus in on the S&P. Maybe we'll bring in some focus as well on the longer term aspects. And I see Abbey Road, you're talking about sustainability cause of further selling. Yeah, interesting. Yeah, like I said, the Fed's not going to move off of where they've been. See if everything's, yeah. Looks like things are working again. 1 second. There we go. That's a better view. But like I've been saying, the Fed's not going to move off of this dialogue that we've been hearing for a while. They're just committed. There's things got so out of hand, running, basically zero interest rates for better part of a decade when they shouldn't have been. They should have been 4 or 5. They should be where they are now. I'm arguing that we've normalized yields. I think they're even a bit low in my viewpoint. I still think the 10-year probably belongs 5.5. And I think that's most likely, most likely what they're going to end up at. And that might take another year or two. And like I said, if they don't start to change that QT, if they
remain at the pace, so we're back to the Fed here, folks. They maintain that pace that they've been liquidating securities to get to Bob's number, not their number, my made-up number, which is 6 to 6.5 trillion. To get the balance sheet down to that level is going to take another year plus, just at the pace they're at right now. So I think we have to expect to see these yields staying higher. I think I've got it handled. One of the things I've been pretty good with, you folks should know, is just the level of yields and how they've been migrating around. And I'm as sure as I've been about anything is that range that I put out last night's Substack is important, which is at 4.25 to, on the basis of 10-year, 4.25, 390, 395 is probably the bottom end, and we just get locked in there. Still a potential spike up into the 430 level, but I don't see it going much above that's extreme, and 390 is kind of the bottom end from the standpoint there on the 10. And ultimately, the back end of the yield curve just is very flattish. It's going along that sideways flat line. And I still am convinced that those numbers that are in the economy right now, folks are talking about the lag. Well, the lag is no longer a lag. The lag is where we are. You could talk about, well, all this big lag in yields. They're all in the marketplace now. That's why we have seen a bit of issues coming into some of the real estate numbers, but there's so much demand for real estate that's going to be limited from that standpoint. And even I think this last report, if I'm going off memory here, was showing that we did flatten out a little bit as far as prices starting to flatten out. And even if they decline a little bit, they're just not going to be any big disaster. How many of you remember last year the millions, tens of thousands anyway for reality, of videos on the coming real estate crash? There's some guy out of Dallas, man, he just won't give up. He keeps getting on my feed when I go to YouTube, and I just have to, the same guy, and now people are talking about all these houses that are being rented by the builders, and that was part of the strategy, by the way. People act like that's a negative. That's exactly part of the strategy. I've been trying to get my brother to come on with me and do a live stream because he's got a handle on the real estate stuff. He's in commercial real estate lending side, and he's told me that how it's way worse than it was in 08, 9, and 10 as far as deals go. But now some things are starting to break loose, and we're starting to see some activity in certain areas. And that's, from my viewpoint, that's just how the real estate market works. It just goes, there's demand there. People figure out how to do deals in the current structure, and they do what they have to do. But the builders, there's a term for it. It's basically build to rent. That's not the exact term, but that's what's going on. These builders are building these houses. They're putting the out there, and they're building them, and they're renting them. And guess what? If prices stay fairly stable, they're going to be able to sell those later. Maybe not all of them to BlackRock, but maybe. They don't actually care, but they're building these houses, the inventory, and they're getting income off of their inventory. I remember way back in the day when the automakers got smart enough to finance their own inventory, GMAC and all those guys. All of a sudden, they thought, well, we're having trouble selling cars. Why don't we finance it? Well, just